I'll take the under. I really don't think so. I'll also take the under on rate cuts. I don't even think we're going to get 3 this year. There's just no impetus for rate cuts. I talk about this, the pollution of the most recent period, right? It's like all the data is polluted, right? The data on, price to earnings for the stock market, it's all too high. And people look, well, the last 10 years, I'm like, well, but the last 10 years have been above average of the last 100 years. So it's just the data is polluted.
Bitcoin prices fell like the Wall Street BlackRock crisis, according to Morgan Creek Capital founder, CIO, and managing director Mark Yusko. He attributed this reduction to the major asset managers' rising interest in Bitcoin. Yusko says Wall Street often suppresses prices. Yusko told Anthony Pompliano that BlackRock and other Wall Street firms carefully assess markets before entering them. Prices are lowered by decreasing the asset's buyer appeal. The article indicates a distinct noun or noun phrase. The founder of Morgan Creek Capital claims BlackRock has manipulated Bitcoin prices since last year, before spot Bitcoin ETFs were approved in January. Since last year, BlackRock and Fidelity have been accused of pricing manipulation. JP Morgan's actions are regularly used by spot Bitcoin ETF critics to demonstrate how giant financial organizations can disrupt a sector to achieve their own aims. Critics have also noted the U.S. Securities and Exchange Commission's enforcement of cryptocurrency sector participants, which coincided with market drops. Ethereum and the Ethereum Foundation are the SEC's latest probe. CC reports indicate that it is collecting data to classify the popular altcoin as a security. Do these activities relate, or is this just cryptocurrency? Variations in markets. In Yo's interview, the famous hedge fund manager talks BlackRock's crash. Thanks for watching. Subscribe to the channel and activate post alerts for more related videos. Thank you and enjoy the video.
And the same thing's true here of rate cuts or interest rate levels. Right? People seem to think that 0 was a normal interest rate. We've had 247 years as a republic. We've had 2 very short periods of time where they pushed interest rates to 0, right after the 1930s debacle with the Great Depression, and then again here after the global financial crisis. That's not normal. 4%, kind of where the 10-year is right now, is normal. So this idea that somehow we need to go back to 2% rates just doesn't make any sense to me. Question that I didn't answer, right? Is inflation going to come roaring back like the 80s? I don't think so. I mean, we've all seen the chart, right? The big spike, the drop, and then the second spike in the 70s. Part of that spike was a false spike in the sense that they were double counting. Volcker's Fed was double counting interest rates, and that they were counting mortgages and interest rates. And there was this weird thing. And Mike Green has talked all about this in the past. So that was the big problem there. So I just don't see that happening. And all of this deflationary pressure that you talk about comes from technological evolution. And technology is not growing linear. Jameson Lopp put out the thing this morning that everybody, which is the Kurzweil chart. And it looks like this linear increase in technology and advancing in compute, but it's because it's on a log scale. And, it's one of the things that drives me crazy all the time. Remember, she shows these hockey stick charts. Well, any long-term chart has to be log scale. You can't look at a long-term chart and, you see like the interest payments and they look all of a sudden like, well, that's because you're looking at 50 years. You need a log scale because going from 10 to 20 is, worse than going from 20 to 30. So all of that says, does Powell look at what's called hedonic price adjustments? Meaning if, technology runs faster or like your washing machine gets your clothes whiter, that, is deflationary in theory. I'm not quite sure why that is, but, okay, so my computer processes faster. I don't type any faster. I mean, I still type at the same rate. So I know that there's some productivity enhancement in having more compute, but for certain productivity, I don't really see it. But I do think on the job front, on your question on AI, as people get displaced, as human beings get displaced, that certainly will change the dynamic of inflationary pressures. My flip side, though, of that, my caution is everyone says at every new technological innovation that is going to destroy jobs. It's true, right? I mean, machines took jobs away from people who were, plowing the fields or assembling things in factories. But here's the thing. We've destroyed millions and millions and millions of jobs through technology. But today, there are more jobs in the world than any time in human history. Right? That's just a fact. So we'll create new jobs, and that will reverse some of that deflationary pressure.
Recent news says that the U.S. Securities and Exchange Commission is using the merge, which is the last step in Ethereum's move to proof-of-stake agreement, to reclassify the most popular altcoin as a security. According to a recent Fortune report, the SEC has sent subpoenas to 3 well-known crypto companies asking for records about the Ethereum Foundation. The investigation into the foundation could give the SEC regulatory coverage to define Ethereum as a security and make it easier to deny BlackRock and others applications for spot Ethereum ETFs. The foundation also said on GitHub that it might be being looked into by a state authority because of the SEC's witch hunting actions and how the agency treated the ETH ETF applications. Recent posts on X say that Bloomberg ETF analysts Eric Balchunas and James Surt have lowered their hopes that the applications will be approved by the May 23rd deadline. The analysts now think that the chances of approval are only 25%, whereas last year they thought that approval was 90% likely for the Bitcoin ETFs. Yusko thinks it's possible that Ethereum ETFs will be allowed in late 2024, after the US presidential election. However, he doesn't think we'll see more cryptocurrency-based ETFs after that. Let's go back to the interview.
First, I think the narrative around Bitcoin tends to shift, right? You go all the way back to the founding. It was a peer-to-peer electronic cash. So we're going to buy pizzas with it. Okay, the guy did. And everybody says, oh, you're an idiot. No, we should all thank him and like bow down because he proved that this thing could allow us to exchange value without a trusted third party. Awesome. Amazing. But it went from that narrative to, oh, it's digital gold. Okay, fine. And gold is an inflation hedge. And so these people say, well, if it's digital gold and it's better, I'm going to buy it because it's easy and I don't have to store it and I have to carry around these big gold bars with me. Okay, fine. But I agree that it's digital, it's scarce like gold. And I believe it's the monetary base for the future, right? Gold's been the monetary base for 5,000 years. And what I mean by that is all the central banks own gold, right? It sits at the base level, and then they create currency on top of that, right? Money is an asset that exists in the absence of a liability. That's been gold. Sometimes it was silver and sometimes it was a few other things. But bottom line, there aren't that many things that exist in the absence of a liability. Currency, dollars, yen, euros, all are backed by debt. They have a liability, associated liability. So they're not money the way we think of money. So I think of the digital gold argument as the monetary piece. Like there's 12 trillion-ish of gold. Half of that is jewelry, artifacts, chalices, gold leaf on the Golden Dome where I went to school, all that good stuff. That doesn't count. That's the commodity part. And gold was the one thing that for years was both commodity, which is kind of an inflation hedge, and currency, right? It was money. And so that Bitcoin narrative was there. But now I like the narrative that Saylor put out there the other day, that it's really digital property, right? It's property rights. And that means it's much, much bigger. And I keep talking about the fact that in the QE era, right, when money supply was expanding, the price of Bitcoin, quote unquote, went up because we measured it in the thing that was devaluing.
BlackRock's fall, or not according to CoinMarketCap, Bitcoin is doing better today. The largest cryptocurrency by market cap is up about 2% in the last 24 hours and about 6% in the last 5 days. It's also a new trading week, which means that spot Bitcoin ETFs have a chance to break more records and help drive up the price of the largest cryptocurrency. What do you think about Mark? Do you agree with Yo's interview that this is a BlackRock crash that won't have any long-term effects on prices? Please share your thoughts, comments, and observations in the section below. Also, make sure you like this video, subscribe to the channel, and turn on post notifications to see more videos like this. You can also check out our other videos with insightful analysis and discussions from Yusko and other well-known figures in the crypto space. Thanks for watching.